What if the market crashes right after you retire? Name the single most destructive thing that can happen early in retirement. The market's going to drop in your first year or two, and because you still need to pay bills, you're going to be forced to sell investments while they're down. That doesn't just sting, it's going to permanently shrink the base of your portfolio, and that's what it grows from. Sell low to eat, and whatever recovery comes has less left to work with. That sequence of returns risk. And it's worse right at the start when your balance is largest and your time to recover is the focus of the whole plan. The trap is that a plan built on average returns ignores sequence of returns entirely. But nobody actually retires into average. You retire into one specific sequence of years. And your plan has to survive the bad sequences, not just the smooth one. What can I do to protect my retirement just in case I retire the year the market decides to go down 30%? The fix isn't picking better investments. It's a withdrawal structure that's going to guarantee you're never a forced seller at the bottom. That's a three bucket system. The idea is to match money to when you're going to spend it. So the money that you need soon is never exposed to a crash. Bucket one are going to be your safe years, the first 5 to 7 years of expenses in conservative, stable assets. This money isn't trying to grow, it's just trying to be there. Early retirees are generally going to need a deeper bucket one than traditional retirees because those gap years are going to run withdrawals higher before Social Security and Medicare. Bucket two are the middle years, roughly years 8 through 15. It's going to be invested for moderate growth, and it's going to be refilling bucket one with sufficient enough time to be able to ride out volatility. Bucket three is your long term money, years 16 and beyond, invested for growth because it has the most time to recover and grow after any downturn. The behavior that makes this work is simple. In a downturn, you're going to spend from bucket one and leave the growth buckets completely alone. We're going to refill bucket one from the growth buckets only when markets have recovered. So you only ever sell growth assets when they're up, never when they're down. That's the whole trick. The structure removes the forced sale decision before the crash ever even arrives. Building and personalizing the three bucket system has two parts that each deserve real care: sizing each bucket to your spending, and then also stress testing the whole plan against the conditions that actually break retirements: an early crash, higher than expected inflation, climbing healthcare costs, or a longer life than planned, or those unexpected large expenses. A plan that only survives good weather isn't a plan. Comment buckets to get the three buckets setup kit plus stress test checklist. It sizes each of the three buckets to your actual spending with that deeper bucket one early retirees need and shows the refill logic in plain terms. We'll run your plan through all the scenarios that generally break retirements, which is an early crash, higher inflation, rising healthcare, a longer life, or those surprise big expenses.